Whether you're a buzzing investor or just generally curious about the world of finance, financial statements are a fundamental subject which provide insight into a company's financial performance and health. As an accountant, this is something which I deal with day to day. So in this video, we're going to break down income statements, balance sheets, and equity statements. The income statement, also referred to as a profit and loss in some countries, shows a company's revenue, expenses, and net income. Now, the income statement helps us understand a company's operations, efficiency, profitability, and overall performance. The income statement is divided into two main sections: the income section and the expense section. So the income section shows all the revenues that a company has earned over a certain period. So this could be sales, gains on investment, and interest income, whereas the expense section shows all of the expenses a company has incurred, again over a select period. So this could be cost of sales, admin expenses, and interest expenses. It should be noted that the income statement is an accumulated balance. This means that the figures we see are often representative of a 12-month accounting period. The balance sheet shows a company's overall financial position. So within the balance sheet, we have assets, liabilities, and equity. It should be noted that total assets equals total liabilities plus total equity. The asset section is split into current assets and non-current assets. Now, current assets are assets that can be converted into cash within a year, therefore they're short term, whereas non-current assets take over a year to be realized, over a year to be converted into cash. Now, within the asset section, we see things such as cash, trade receivables, and property, plant, and equipment. The liability section is also split into current liabilities and non-current liabilities, and within the liability section, we see things such as trade payables, tax liabilities, and debt. It should be noted that the balance sheet is a snapshot at a certain period in time. It's not an accumulated balance, but the balance sheet can be really useful for calculating ratios used in investing. So for example, you can calculate solvency ratios, debt to equity ratios, working capital ratios, but that whole section on balance sheet ratio investing would be a completely separate video because it's more of a deeper dive. Within the balance sheet, we also have the stockholders' statement of equity. Now, this is a useful section to understand how a company is growing and financing its operations. It also shows how profits are being distributed to the company's shareholders. The statement of equity is a bit more intricate, and just like balance sheet ratios, this could be a whole different video where we cover all the different components. But generally, these are the main components which we see in the statement of equity. We have common stock, so this is the amount paid by shareholders in exchange for capital. We have retained earnings. This is the amount of earnings retained by a company minus the dividends paid out. We then have net income. This comes from the income statement within the year. And then we have dividends, the amount paid to shareholders. And that is a crash course into financial statements. Now, don't get me wrong, this was a high-level video. For reference, it took me 3 years to become a qualified accountant, so we're not going to cover it all in a 5-minute video. But I hope you learned something from this video. Please leave a like if you did enjoy it and subscribe for more videos about finance.